Alright, listen up because I'm about to tell you about a stock that could be an absolute game changer, a titan in the making. I'm talking about Eos Energy Enterprises, ticker EOS. This isn't just another flash in the pan, folks. This company is strategically positioning itself to become a powerhouse in the energy storage sector, an industry that is absolutely critical for our future. We're talking about the backbone of the green energy revolution, and Eos is building that backbone right here in America. They are developing and deploying technology that could redefine how we store and use energy, making the grid more resilient, more reliable, and ready for the renewable energy boom. This is a story of innovation, American manufacturing, and massive growth potential. Booyah! Now let's talk numbers because numbers don't lie. EOS is forecasting full year 2025 revenue to be between a staggering $150 million and $190 million. Can you believe that? This isn't some pie-in-the-sky dream. This is based on real, tangible factors like significantly higher production volume. And how are they going to achieve this monumental leap in production? Through smart investments in automation and capacity expansion, that's how. This kind of revenue projection signals a company that's not just growing, it's exploding onto the scene. They are laying the groundwork today for the profits of tomorrow, and investors who get in now could be looking at some serious green. This is the kind of growth story that gets my blood pumping. The secret sauce to this ramp-up in production is automation, my friends. Eos is expecting the full implementation of its staged sub-assembly automation by early Q3 2025. Think about what that means. Faster production, higher efficiency, and lower costs per unit. This is how you scale a manufacturing business in the 21st century. They're not just building batteries, they're building a high-tech manufacturing powerhouse. This automation drive is crucial for meeting the burgeoning demand for their innovative energy storage solutions. It's a smart, forward-thinking move that will allow Eos to churn out their Zenith trademark batteries at a pace that will leave competitors in the dust. This isn't just about keeping up, it's about leading the pack. And let's not forget their groundbreaking technology, the Zenith trademark aqueous zinc battery. This isn't your standard lithium-ion fare, no sir. Eos's Zenith trademark technology is designed to be a safer, more scalable, highly efficient, and sustainable alternative. And get this, it's manufactured right here in the USA. This is a crucial differentiator in a world increasingly concerned about supply chain security and a reliance on foreign manufacturing. This technology is perfect for those longer duration storage needs, from 3 to 12 hours, serving utility, industrial, and commercial customers. This is American innovation at its finest, tackling a global energy challenge with homegrown ingenuity. This is a game changer, plain and simple. Now, a company with big ambitions needs big financial muscle, and Eos is flexing. They recently announced a common stock offering, expected to bring in net proceeds of around $70.5 million, potentially even $81.075 million. What are they doing with this cash infusion? They're playing it smart, using it to repurchase $126 million of convertible senior notes and prepay $50 million of outstanding borrowings. This is strategic debt management, folks. They are cleaning up the balance sheet, reducing their interest burden, and paving the way for future growth. This isn't just shuffling deck chairs, this is building a stronger financial foundation. These are the moves of a company that's serious about long-term success. The impact of this debt management is huge. By prepaying a chunk of their credit agreement, Eos is set to slash the PIK interest rate from a hefty 15% down to a much more manageable 7%. That's a massive saving in interest payments, money that can now be reinvested into the business. And get this, they've also managed to get their financial covenants waived until 2027. This gives them incredible breathing room and flexibility as they scale up operations. Furthermore, they announced a private offering of $225 million in convertible senior notes due 2030, showing continued access to capital markets. This financial maneuvering is music to my ears, demonstrating shrewd leadership at the helm, and the funding keeps rolling in. Eos has closed a $303.5 million loan guaranteed by none other than the U.S. Department of Energy's Loan Programs Office. When Uncle Sam puts their stamp of approval on you with that kind of backing, you know you're onto something big. The initial funding tranche of $68.3 million is already in the bank. On top of that, they've hit their third tranche of operational milestones, securing the final $40.5 million of a $210.5 million term loan from Cerberus Capital Management. This isn't just pocket change. This is serious capital flowing into a company poised for exponential growth. The smart money is betting on Eos, and so should you. But what good is all this capacity and funding without demand? Well, Eos has that covered too in spades. Their customer orders backlog ballooned to an incredible $682 million as of the end of 2024. That's a 28% increase year over year. That's not a typo, folks. $682 million. And if you think that's impressive, their commercial opportunity pipeline has reached a mind-boggling $14.4 billion. That's billion with a B. This shows that the market is hungry, absolutely starving, for Eos's energy storage solutions. The phone is ringing off the hook. This kind of demand is a clear indicator of a company on the verge of a massive breakout. To meet this incredible demand, Eos is dramatically expanding its manufacturing capacity. They've launched Factory 2 Works, an ambitious project to build out even more production capabilities. 8 states have already responded to their request for proposals, and multiple sites have been shortlisted. This isn't just about adding a new production line, it's about creating a manufacturing juggernaut. They are planning to procure 3 additional manufacturing lines, which are set to support an additional 6 GWh of annualized capacity. This is how you scale to meet the needs of a rapidly growing market. They are building the future, 1 GWh at a time. Furthermore, Eos is boosting the output of its existing infrastructure. They're in the process of expanding their first manufacturing line from an already impressive 1.25 GWh to a formidable 2 GWh of annualized capacity. This relentless focus on increasing output combined with the automation drive I mentioned earlier is critical. It ensures that Eos can deliver on its massive order backlog and continue to capture market share. This isn't just about building more, it's about building smarter and faster. The company is clearly laying the groundwork to become a dominant force in energy storage manufacturing right here on American soil. This is manufacturing renaissance, baby. At the heart of this success story is Eos's innovative Zenith trademark aqueous zinc battery technology. This is the differentiator, the secret weapon. As I said, it's designed to be a safe, scalable, efficient, and sustainable alternative to conventional lithium-ion batteries, particularly for those crucial 3 to 12-hour energy storage applications. This addresses a critical need in the market for longer duration storage that lithium-ion often struggles to meet cost-effectively. Utility companies, industrial giants, and commercial enterprises are all potential customers for this groundbreaking technology. It's a US manufactured solution for a global energy problem, and that spells opportunity with a capital O. The strategic importance of what Eos is doing cannot be overstated. Their American-made energy storage systems are being highlighted as absolutely crucial for enhancing military resilience and bolstering US energy independence. Think about it. Secure, reliable energy storage made domestically reduces reliance on foreign supply chains, especially for critical infrastructure. This isn't just a business, it's a matter of national interest. When your technology supports the nation's security and its energy future, you're not just building a company, you're building a legacy. This strategic alignment adds another layer of strength and long-term viability to the Eos story. This is patriotism and profit hand in hand. The market is clearly recognizing the value Eos brings. They've secured some very impressive orders that demonstrate growing trust in their technology. A standout example is the $8 million order for Naval Base San Diego. When the US Navy chooses your technology, that's a 5-star endorsement, my friends. But it doesn't stop there. They also have key contracts with a municipal cooperative in Springfield, Missouri, and the US Marine Corps base at Camp Pendleton. These are significant wins that showcase the versatility and reliability of Eos's systems across different demanding applications. These contracts are the lifeblood of growth, proving market acceptance and paving the way for even bigger deals. Let's look at the recent financial performance. In Q4 2024, Eos reported revenue of $7.3 million. Now listen to this, that's a 10% increase year over year, but an astounding 749% increase quarter over quarter. That's the kind of explosive growth that turns heads on Wall Street. Full year 2024 revenue came in at $15.6 million, right in line with their revised guidance. And importantly, they had total cash of $103.4 million. As of December 31, 2024. Yes, the company reported net losses in 2024, but this is typical for a company in a high-growth phase, heavily investing in R&D, capacity, and market expansion. These are investments in a much larger, profitable future. Eos is also taking smart steps to enhance the bankability of its technology. They've launched a comprehensive insurance program with Ariel Green. This program includes investment tax credit, ITC protections, and crucial performance guarantees for their energy storage systems. This is huge for de-risking projects for customers and financiers. Furthermore, they've updated their standard warranty to a solid 3-year term, with options to extend it to 5 or even 10 years. This demonstrates immense confidence in their product's durability and performance. These moves make it easier for customers to say yes to Eos, accelerating adoption and sales. That's how you build market trust. Finally, you can't have a winning company without a winning team, and Eos has been strengthening its leadership. They've brought on Nathan Croker as Chief Commercial Officer and Eric Javidi as Chief Financial Officer. Javidi brings extensive experience in the energy and infrastructure sectors, exactly what Eos needs as it scales. Operationally, they've achieved SOX compliance, a testament to strengthened internal controls. They've also been laser-focused on efficiency, reducing Z3 material costs, improving manufacturing cycle times, and boosting first-pass yield. They even surpassed their raw materials cost-out target. This is a company firing on all cylinders, led by a seasoned team, ready to take Eos to the next level. Booyah! This stock is a buy.